Good afternoon, everyone, and welcome to another ITPM Flash. My name is Anthony Iser. Well, it's Thursday here in Melbourne. We've got 5 days before the US elections. Everyone's waiting with bated breath to see who is going to run the US for the next 4 years. There's lots of trade ideas out there, specifically targeting outcomes in that election. Trades if Trump wins, trade if Harris wins. The trade I'm looking at today is agnostic as to who wins. And I want to have more trades like this. I want to have positions where I don't have to rely on one particular outcome. The company I'm looking at is Celsius Holdings. Now, you look at this chart here and you might think, what on earth is going on? The stock's down 70% from its high in May. It's down 42% year to date. And it's been under all sorts of pressure. But I think that is probably coming to an end. If it's not coming to an end with the results next week, it will be soon after that. And I'll talk about what the issues are and why I think they're ending. So firstly, Celsius are an energy drink company. They've been growing rapidly over the last decade, and particularly over the last 3 or 4 years, all across the US. Their drinks are proven to burn calories, proven to burn fat, proven according to their claims, and have grown, as I said, rapidly, and particularly at convenience store sales, particularly with gym goers, and particularly with women. So a big market growing across the US. Now, some of the issues have been that the average household spend on energy drinks is slowing. It was growing at 16% per annum, that helping to grow the entire sector. That's down to 7% now. 7% is still more than 2 times GDP. So this is still a good number, but we're getting a little bit of saturation in the entire market. But that entire market is still growing. The biggest issue has been their deal with Pepsi. Now, their deal with Pepsi's provided funding and has provided access to their distribution network. And that drove growth really strongly over the last couple of years. That drove the share price, it drove sales, it drove earnings. But what Pepsi has done, it's filled its entire distribution network with Celsius product, and it's gone a little overboard. Essentially, whether it's a warehouse, whether it's on the back of trucks, whether it's convenience stores, they've taken too much product on. The end sales are still going along really well, but that whole chain, that whole distribution chain is just full of Celsius products. So it just needs to work its way through. This is an inventory issue that we've got going on here. Their market share implied from sales is slowing a fraction. New shoppers percentage has come down over the last couple of years from 65% to 38%. But that means repeat customers are coming through quite strongly. And as they expand into international markets, then we're going to see those new customer numbers going up and those repeat customers coming through, driving additional volume. So the company's got a really long runway for further expansion in the US and expansion across Europe, Asia, Pacific, and South America. So there's no headwinds outside of this temporary issue with inventory. The company has talked about it. They see it being remedied over the next quarter or two. There might be signs of that in this next quarterly result. So we may see this share price bottoming out around these levels and picking up from here. And these declines are not to be dismissed. Down 70% from its high is massive, but it's also understandable when a big high growth company has sales and earnings miss and outlook downgraded. So we've seen substantial downgrades, but as this chart here shows, we've also seen substantial derating in the market multiple, not the market multiple, the PE multiple for Celsius. So 75 to 80 times back in May is what people were prepared to pay for that super strong growth. As that growth rolled over, became a concern, downgrades came through, you can see now that the multiple is contracted. It's down to 36. I think as we get comfort around the earnings outlook beyond this next quarter or two, we're going to see a couple of things happen. Firstly, we're going to see earnings upgrades start to come through. Now, they may be some way off, but before the analysts start upgrading, we're going to see the market paying a bit more for it. So we're going to see that multiple expanding again. And the earnings outlook at the moment is still pretty good. We've got 19 and 16% sales growth forecast for 25 and 26 after being down to as low as 6 in terms of forecast for 2024 with these last couple of quarters to go. On the earnings side, after 2,000% EPS growth in 2023, driven by low numbers, we saw basically flat earnings in 2024, but that's returning to 28 and 22% for the next couple of years after that. So I think we're going to see these earnings bottoming out, upgrades coming through over the next quarter or two, but the market's forward looking. I think we're going to see anticipation of that and the share price starting to rise reasonably rapidly. Is it going back to 90? I don't know. It might down the track, but I don't expect it to in the short term, and I don't need it to in the short term. Once we've got those that comfort around earnings, we're going to see that multiple expand a little bit. And then the follow through from there on in will be earnings upgrades and upgrades to price targets from the analysts out there. Now, you can see from this chart here, it's been a steady stream of downgrades in price targets from the analysts. You can also see that it's lagging the share price, as analysts always tend to do. But that average price target there of $45 is the price target that I think we can get to over the next few months. So when I look at this, I'm looking for some signs of change in the next result, ideally. But if it doesn't happen, I think it'll come through in the months after that. So my trade structure is reflecting that. I'm looking a little bit further out. So I'm going to go to January. I'm going to look at a bull call spread, and I can buy 35 and sell 45 call options for around about a $1.70 cost. That comes out to a 5-to-1 payoff ratio, which is, I think, pretty spectacular for a company like this, with 10% short interest out there, lots of negative news, but this is a temporary problem. Most of the market knows a temporary problem. They're just trying to work out when it ends. So I think as soon as we see signs of that, we're going to start seeing this stock pick up. And like I said at the start, the most important thing here is it doesn't matter who wins the election. It doesn't matter about what happens in macro world over the next little while. Geopolitics, don't care. This is a stock that sells a product in an industry that has tailwinds. It's got a temporary hiccup. It's going to wash through. And on the other side of that, we're going to see a return to growth. We're going to see the multiple expand, and we'll see upgrades. The multiple doesn't need to get back to 75 times. It just needs to pick up from the 36 times it is now into the mid-40s, seeing upgrades come through, and then the multiple might expand further as we come out the other side. So it's going to be those combinations of things I think will get us to $45. A 5-to-1 payoff ratio is what I'm looking at here. So enjoy the election, enjoy the mayhem, the commentary, and all that sort of stuff. But like I said, this idea doesn't rely upon any of that. And I think it'll do well over the next couple of months. Thanks very much for listening. Talk to you soon. Bye.